All right, so no questions on the non-mover. This is the volatility crush trade. So this takes that same trading strategy into account. Like Sudhir had mentioned, I think his results have shown an 80% win rate on this particular trading strategy. I really like this trading strategy as well, mainly because it does offer a really good risk to reward. And typically when you're trading these trades based off of earnings, you're getting in today. Let's say for Lanier, they have earnings coming out tonight. You're getting in today prior to the close, and then you're going to be out tomorrow before the close as well. So the trading windows, 24 days, let's say, or 24 hours, excuse me. So fairly quick, and you're in and out of the trade. And I just find that risk to reward to be a good one as well. So volatility crush, if you don't know, so after a company reports the earnings, the stock price can move in one direction or the other. And basically what happens is coming into earnings, there's a lot of anticipation or potential volatility that's going into that particular stock. And therefore those price values are going into the options, and that implied volatility is going to increase the value of the options. And therefore you can sell those options and kind of pull in that credit. Typically after the earnings announcement, if nothing happens, big to the upside or big to the downside, then you'll see a big decline in those options value or the option prices. And that's just basically that implied volatility or that volatility coming out of those options immediately after that earnings announcement. And again, we call this trade basically a vol crush, and that's the reason. It's a volatility crush, implied volatility before getting crushed, and therefore that's the name. Again, this strategy is similar to the non-mover. We're looking to capture 15% of that credit. We used a more aggressive 40% target last earnings announcement, and typically, or last earnings quarter, excuse me. Typically the 40% is doable on some of these trades, like the Lanier maybe today, if you're trading those options that are going to expire this Friday, but your trade window or your maneuverability is very limited if you're trading options with such a short time frame. So that's why we found using those options that expire next week might help, add some maneuverability to you if you do get a big move or big move up or big move down on these stocks. One that comes to mind last quarter is Apple. If you look at a chart of Apple, and if I remember, I'll show you later. After their earnings announcement last quarter, Apple had a big move to the upside. So, with those particular options, if you're trading options that expired within 2 days, you just don't really have much to do except, let those options go and kind of take the loss on the trade. But if you're using options that expire the following week, again, it just gives you a little more flexibility. So 15%, I changed it to this one to 15%. And, just like the other trades and just like what Josh had mentioned, if you think 15% is a little too low and you want to try to gain a little more profit on some of these trades, you can test it within Delphian and take exactly everything we've set up here and just try to adjust some of those numbers and see if they fit into your investment profile. And if they do, and you like taking on a little bit more risk to take on, to potentially capture a little more profit, by all means test it. And if the numbers show, a reason to do it, then, implement that into your plan if you want to do so. But we use 15% for this one. Again, same thing as before, the trades close when certain conditions are met, the profit targets met, or the day after the earnings release. And again, the iron butterfly is a great strategy just based on the fact that you can collect that credit and you're protected on the upside and the downside by buying those options or buying those wings. Again, just looking for sharp volatility, a sharp drop or reduction in the volatility premiums the day after earnings. And certain strategies are just, for this trade, are just not viable options. So certain long strategies are not viable. You can do short call spreads and short put spreads if you want to test them to see. That's going to be taking a little bit bias on the market. If you're basically selling a call spread, you obviously are expecting the stock potentially to go down. So you're going to take a bias. But the beauty about the vol crush is you're selling, the call spread and you're selling the put spread. So really, you just want the stock to move sideways. You're not really taking a direction per se. I guess you're taking a sideways direction, but you're not picking, hey, is this stock going to go up or go down? But again, you can test it if you do have the bias in that particular scenario. Again, this iron butterfly is constructed the same way as the non-mover, except there are some notes here to be made on the strike selection. When we're talking about the vol crush, what we're looking at is we're looking at the potential expected move of a stock. So when earnings announcements are coming out, you can look at what the market makers and what the market's expecting the stock to move, and that's called the expected move. And the expected move, we do have the availability to look at that on our option chains, but an easy way to do it, or a simple way to do it, is to basically take the value of the closest expiration after the earnings announcement, and you're going to add the value of the at-the-money call and the at-the-money put, and that'll give you the potential expected move. So what we're looking for this strategy is we're looking for the stock. I mean, the stock can move. It can move sideways, or it can move a little bit up, or it can move a little bit down. But as long as it doesn't move outside of that expected move, or too much higher than that, we should be, okay on this trade in theory. So that's why I'm using the expected move as my legs that I'm buying. So my buy one call here, I'm using the expected move from the strike that I'm buying, and my buy two put, I'm using the expected move from the strike of this particular put. So in that case, if the current price of Microsoft is $200, let's say the expected move is $20, I'm going to sell the $200 call and the $200 put, and then I'm going to use the $220 call and the $180 put as my protection, because those are both $20 on each side, or the expected move on each side away from the current price of the stock. So the construction of this vol crush trade versus the non-mover is a little bit different. Again, the trading strategy for the non-mover, I'm using 10% on both sides from the current price of the close of the stock price. And then on this one, I'm using the expected move. And then same, I'm using the weekly options, and I'm using 6 days to expire. I just talked about that. Again, the candidate selection is pretty similar to what I talked about on the non-mover, except here with my earnings, I'm using a price change as less than or equal to either direction's expected move from the earnings day to 1 day after, 6 out of 10. So basically saying that the stocks, or these lists of stocks, typically do not move outside of that expected move range. 6 out of 10 earnings. I tried to do some 7 out of 10, 8 out of 10, 9 out of 10, and so on, and that can be done. But again, your list or sample size is going to get smaller, the more narrow you get on these selections. So I was able to pull in a bunch of symbols and then filter them out as I see fit. But all the other criteria are the same as the non-mover. So we're looking at Netflix. So Netflix is a good one. You can see here, typically, we don't have the expected move. I didn't put the expected move on this chart, but you can see the earnings here. The stock kind of moved sideways. Earnings here, it kind of moved down a little bit, or here gap down, and then here had a big gap down. So depending on what the expected move was on these particular earnings announcements, your expected move could be way down here, and if it is, then this trade could potentially be profitable. It depends. I'll need to make an adjustment to this slide to kind of see if I can put the expected move on there. But you can see the different announcement dates with the price. So if I'm looking at this last trade here, which was in the end of October, you can see this past earnings quarter on 10/20, the credit versus the profit the very next day. So the stock did drop, and that's why it was able to eat into a little bit of that profit, because we did have the stock drop. So that kind of took away from some of our credit that we initially received. If I look at the trade in April, $4,500 credit, but I was able to take almost a $1,200 profit the next day. I want to go back and look at that April trade, and you can see here's the April trade here, and you can see the stock opened the next day down a little bit and kind of chopped in between, but we didn't have a big gap like we had here. So that's why we were able to take a little bit more profit on that April trade. And this one, we weren't able to take as much of a profit. 90% win rate for the vol crush strategy using Netflix, 9.45 profit factor and $5,000 profit over time. I'm showing you Microsoft had a similar fashion here. Again, no expected move, but I need to put those in there. You can see it kind of bumped up a little bit sideways, dropped down a little bit sideways. This one had a sideways and then drop. This one had sideways and then drop as well. So we can see, some of these based on the credit we received versus the profit are a little bit lower based on those gaps. And then we can see this trade here in July, we would have taken a loss on the trade. Q3, which is the one we did this past quarter, a little bit of a profit if you got out the next day. 90% win rate, 16.35 profit factor, and $920 profit over time. Planning the trade, 38 symbols had met that vol crush criteria. And again, I used a profit factor above 2.0. 11 trades potentially for the Q4 had a win percentage between 70 and 79.9, 12 between the 80 and 89.9, and then 5 between 90 and 100. Similar setup here when you're executing the trade, talking about getting into it before the earnings announcement, just making sure you're looking at before market open or after market close to make sure you're timing entry into the trade properly. You don't want to get into the trade after the earnings announcement. It pretty much defeats the vol crush purpose. Risk to reward scenario here, I'll show you again in the virtual portfolio, but I typically want my risk to reward to be a 1 to 2, meaning if I'm risking 1,000, I'm going to collect about 2,000 for my credit. That seems to be a fairly sweet spot from what we've kind of tested out before, but you're going to see some ones that are different. You might see some that are 1 to 1, and you might see some that are 1 to 4, it just depends. But I at least want to try to get a 1 to 2 risk to reward when I'm constructing these trades. And again, I'll show you in a second. Implied volatility is a big one. With the vol crush, we're looking for the volatility to drop out of those trades. So for instance, some of these on those near the options that are expiring immediately after the earnings announcement, you might see an implied volatility of 100% on some of those options. And then the day after the earnings announcement, those options might drop to a 30% implied volatility. Those are the ones where you're going to see the bigger vol crush typically that are going to probably work a little bit better for this trade setup. So if you can get some implied volatility to be pretty high when you're selling this vol crush trade, those are going to be better. And again, your option open interest, and you want your option volume to be high like we talked about before. Again, same trade, iron butterfly, make sure you're using limit orders, understand your risk before you enter into the trade, and always have that plan ready to go no matter what happens. Even if it seems like it's pretty basic, I want you to always have a plan of what to do, because when something does come about, you'll be ready to do it, whether it be a profit or a loss. Some people have hard times taking nice profits, and some people have hard times getting out when they're at a loss. But if you have that plan ahead of time and you stick to it, it makes it a lot easier, and you kind of can't second guess yourself too much that way. Once the trade is entered or you're filled, put that 15% profit in there to get out. Like Josh mentioned earlier, super important to do that. And again, just the same additional notes that we have here. You're selling options that are at or in the money, so you have that risk exposure of getting exercised. And then there are 4 legs to these options. Let me show you the trade setup on this one as well. So using a similar setup for linear, I'll change it. I use 10% here because we're using the non-mover at a 10% in either direction, but now we're looking at doing an expected move. I saw a potential question come up. Josh, is that for me or is that something else? All right, that was something else, so sorry about that. All right, so using the same setup as we talked about for linear. Linear has earnings coming out tonight. The stock's moving a little bit higher right now prior to the close, but let's just assume the stock is still around that $74 range. If I'm using next week's expiration and I'm using the options to sell at $74, you can see approximately my expected move for next week's expiration is just the value of these 2 options added together, which is roughly, let's just say $5 for the lack of doing more than that. So if my expected move is $5, then I would want to add $5 to my 74 call, and I would want to add $5 to my 74 put. So I would do a 79 call, and then I would do a 69 put. And this would be essentially my vol crush iron butterfly trade that I'd be looking to put on today prior to the close for the earnings announcement tonight. So we can see the credit that I receive is approximately $354, and my max risk is the difference between $5 and $354, which is $146. So if I times 146 times 2, that's well below my 354. So this one is offering me essentially a 1 to about a 2.5 risk to reward. So, I'm risking 146, but I'm collecting, more than 2 times that by collecting the 354. So that's what I'm talking about when you want to make sure, you're getting at least a 1 to 2 risk to reward credit. I want to show you another example. So if I duplicate this real quick within the platform, and then I go into my options chain, I'll show you where you can pull up and see those different expected moves. So I'm going to click expiry for, if I wanted to look at, well, the 1224 is the one I had on that virtual portfolio. So if I click 1224 there, you can see my expected move is $5.10. So roughly $5 like I put on that virtual portfolio trade here. If I was looking at options that expired this Friday, the expected move is going to be different, right? Because the stock has more time to move next week in either direction. So the expected move, would be different. So if I click on 1218, we can see now my expected move is $4.36, which is for options that expired this Friday. On this stock, there's not that much of a difference. However, if you look at some stocks like Tesla or Amazon, some of those others that can make really big moves over a short period of time, you'll see your expected move with different option expirations is going to be substantially different, or can be substantially different. So that's kind of the setup for this particular trade here. I wanted to show you that. So you're looking at the options that expire next week with the earnings that's coming out, today, tonight. And then you can see my max profit is 354 on this trade. If you wanted to figure out what 15% of that was, just take 354 times 15%. You can figure out what you should be looking to exit the trade out tomorrow after the earnings announcement, which is tonight. Any questions on that? Those two trades, the non-mover and the vol crush, are a little more complicated because you're dealing with 4 legs. You're dealing with selling options that are at the money, and then you're buying the options for protection. So again, I know I said this before, but I feel that this tool here within the organizer and our virtual portfolio is a great tool for you to use to learn how these strategies work and to put them in your account. Because when you put it in there, you can see, okay, well, here's my risk, here's my potential profit, and you can see how those trade values move, from day to day. The beauty about the virtual portfolio within Delphian as well is you can actually go back in time. So I'm using the current data as of the close of business yesterday, but if there was a trade that I wanted to analyze, back last January or 3 years ago, I can go back in time to that particular time frame, put that trade in the virtual portfolio within Delphian, and then move it forward and find how that trade is moving over time, back in the past. So it's very functional on ways that you can use this as a great learning tool to help you with your trading. And I would advise a bunch of people to go in there and do it not only in times when you think the trade might make a profit, but do it in times such as February of March of this year when COVID happened. And if you're bullish, you can really see how that negative move in the market really affects your portfolio. And then I think you can really get a good idea of your mindset and how you would react, with times of that happening. Obviously, you can foresee what the market was doing because we're looking at something that's happening in the past, but using that in the virtual portfolio, I think it gives you a good idea of how are you going to react when, X happens and what are you going to do? And that'll give you a good idea of, I think how you would react within your actual live trading as well. So if there's no questions, I'll move on to the next ones. The next trades aren't as difficult. So, we're talking about a bullish runner and a bearish runner. So long call, long put, so a lot easier. So these are probably the most difficult ones in my mind, I think. So, definitely any questions. There's no, dumb questions when we're talking about strategies like these, because these can be somewhat confusing. So,